Introduction. In the landscape of modern business finance, budgeting, forecasting, and financial planning form the foundation of strategic decision making. They provide a financial roadmap, help anticipate future performance, and ensure that resources are allocated efficiently to achieve organizational goals. This module covers the differences and interconnections between budgeting, forecasting, and financial planning techniques and tools used in each strategic approaches to budget development and implementation case examples from real businesses, especially in Nigeria and emerging markets. Defining budgeting, forecasting, and financial planning. Budgeting. Budgeting is the process of creating a detailed financial plan for a specific period, usually a year, that outlines expected revenues and expenses. Purpose: guides daily operations, controls costs, aligns departments with strategic goals. Forecasting. Forecasting involves estimating future financial outcomes based on historical data, trends, and assumptions. Purpose: predicts sales, revenue, market growth, or costs. Identifies emerging risks and opportunities. Supports scenario planning, financial planning. This is a broader, long-term process of setting financial objectives, determining required resources, and outlining strategies for achieving business sustainability and growth. Purpose: drives investment decisions, supports funding and expansion plans, helps in valuation and stakeholder communication. Key components of a business budget. A typical corporate budget includes sales budget, forecasts revenue based on units sold and price per unit. Operating budget includes expenses related to operations like rent, salaries, utilities. Cash budget projects cash inflows and outflows to ensure liquidity. Capital budget allocates funds for long-term asset purchases like equipment or property. Master budget consolidates all other budgets to give a comprehensive picture. Example: Naira component, January, February, March quarter, 1. Total sales revenue, 5 million, 5 million, 500,000, 6 million, 16 million, 500,000. Operating costs, 2 million, 500,000, 2 million, 700,000, 3 million, 8 million, 200,000. Net profit, 2 million, 500,000, 2 million, 800,000, 3 million, 8 million, 300,000. Techniques for forecasting. Financial forecasting techniques can be classified into qualitative and quantitative. 1. Qualitative techniques. Expert opinion, Delphi method. Market research, scenario analysis. 2. Quantitative techniques. Trend analysis, using historical patterns to project future values. Moving averages, smooths out fluctuations in data. Regression analysis, explains the relationship between variables, e.g., sales and marketing spend. Time series modeling includes seasonal and cyclical adjustments. Example: a retailer may forecast Q4 sales based on historical data from previous Q4s, adjusting for inflation and holiday trends. Best practices in budgeting. Participatory budgeting involves departmental heads to increase buy-in. Zero-based budgeting, ZBB, starts from scratch each period, justifies every line item. Rolling budgets, updated monthly or quarterly, always extending a year forward. Flexible budgeting, adjusts for changes in volume or activity level. Tools, Excel and Google Sheets. ERP systems, e.g., SAP, Oracle. Budgeting software, e.g., QuickBooks, FreshBooks. Linking forecasts and budgets. Forecasts influence budgets by helping organizations anticipate revenues and cost drivers. For example, if forecasts predict inflation, the budget should reflect increased costs. A drop in expected sales may lead to revised marketing allocations or staffing levels. Budget equals strategic plan. Forecast equals realistic estimate. Both tools must be aligned to avoid cash shortages, overstocking, or underinvestment. Strategic financial planning. This process links financial decisions with long-term corporate goals. It includes vision and goal setting, e.g., expand into 5 new markets, investment appraisal, NPV, IRR, payback period, capital structure planning, debt versus equity, contingency planning, economic shocks, policy changes. Example, a Nigerian agribusiness planning to expand into northern Nigeria would create a 3-year plan estimating infrastructure costs, staffing, supply chain development, and projected revenue. Budget variance analysis. This is the comparison of budgeted figures versus actual performance, often performed monthly or quarterly. Types of variances. Favorable variance, actual revenue greater than budgeted or actual expense less than budgeted. Unfavorable variance, actual revenue less than budgeted or actual expense greater than budgeted. Causes, poor estimation, economic shocks, changes in demand, operational inefficiencies. Example, item, budget, actual, variance, interpretation, sales revenue, 5 million, 4.5 million minus 500,000 unfavorable, lower sales, salary expenses, 1.5 million, 1.2 million plus 300,000 favorable, cost savings. Challenges in budgeting and forecasting. Inflation and currency fluctuation, especially relevant in emerging markets like Nigeria. Inaccurate data leads to wrong assumptions and poor decision making. Overly optimistic forecasts can create unrealistic expectations. Lack of flexibility. Static budgets may become obsolete quickly in volatile environments. Human bias and politics. Departmental competition may lead to misrepresentation of needs. Role of technology in budgeting and forecasting. Modern businesses leverage technology to improve accuracy and efficiency. AI-powered forecasting tools, predictive analytics, cloud budgeting platforms, integrated dashboards and real-time reporting. Benefits, better visibility, quicker decision-making, fewer manual errors, collaboration across departments. Budgeting and planning in the Nigerian business environment. Local context factors, fluctuating oil prices, government policy unpredictability, exchange rate volatility, power supply inconsistency. Approach, conservative revenue forecasting, scenario-based budgeting, best case, base case, worst case, increased contingency reserves, multiple currency budgeting. Summary and key takeaways. Budgeting and forecasting are foundational to financial control and strategic decision-making. Financial planning ensures long-term viability and resilience. These tools must be dynamic and frequently updated in response to internal and external shifts. Effective use of data, software, and cross-functional collaboration improves outcomes. In volatile economies like Nigeria, flexible and scenario-based budgeting is essential. A budget is telling your money where to go instead of wondering where it went. Dave Ramsey.